So I am Cantutay Kimberly Ann, and my report is a continuation of the report of Ms. Sapanta, which is about other exception. Without further ado, I will start. Business combinations. A first-time adapter exempted from applying PFRS 3 business combinations retrospectively to business combinations that occurred prior to date of transition to PFRS. However, if it elects to restate any business combination to comply with PFRS 3, it shall also restate all subsequent business combinations. For example, a first-time adapter may apply to PFRS 3 prospectively from January 1, 20 by 2 date of transition. If, however, the first-time adapter elects to restate a business combination that occurred on April 1, 20 by 1, it shall also restate all business combinations that occurred between April 1, 20 by 1 and January 1, 20 by 1. So, to determine if a business combination has happened, an acquirer must first evaluate whether it has acquired a business or a group of assets. Number 4 is a fair value or revaluation amount as deemed cost. So, an entity adapting the cost model for its property, plant and equipment, investment property, intangible assets is permitted to measure those assets at the date of transition to PFRS at fair value and use that fair value as their deemed cost at that date. Alternatively, the entity may elect to use a revaluation amount determined under its previous GAAP as the deemed cost at the date of revaluation. If the revaluation is comparable to fair value or cost or depreciated cost in accordance with PFRS, adjusted to reflect, for example, changes by general or specific price index. So, revaluation amount is an adjustment made to the recorded value of an asset to accurately reflect its current market value. Next is the cumulative translation differences. Is the first time adapter is permitted to zero out any cumulative translation differences recognized in equity under the previous GAAP. Next is the compound financial instruments. A first-time adopter need to separate the two components of a compound financial instrument, i.e. liability and equity components, if the liability component is no longer outstanding at the date of transition to PFRS. So, compound financial instrument is a financial instrument that has the characteristics of both an entity and liability. One example would be a bond that can be converted into shares. So, presentation and disclosure. The first PFRS financial statements shall include at least 1 year comparative information. Next is if the entity presents non-PFRS comparative information and historical summaries for periods before the date of transition, e.g. summary of income and expenses earned in the previous 3 years. It need not restate those summaries to PFRS. However, it shall label them as being prepared in accordance with the previous GAAP and shall disclose the nature of the adjustments that would make those summaries comply with PFRS. The entity shall explain how the transition from previous GAAP to PFRS affected its financial position, financial performance, and cash flows. This includes, first, the reconciliations of equity reported under previous GAAP to equity under PFRS both at the date of transition to PFRS and the end of the last annual period reported under the previous GAAP. B is the reconciliation of total comprehensive income for the last annual period reported under the previous GAAP to total comprehensive income under PFRS for the same period. C is the disclosure of impairment losses and reversals of impairment losses recognized when the opening statement of financial position was prepared. D is the disclosure of errors discovered in the course of transition to PFRS. E is the material adjustments made to restate the financial statements to PFRS. And lastly, appropriate explanations if the entity has elected to apply any of the exceptions permitted under PFRS 1. So that would be all of my report. Thank you.